The world's major central banks are holding their ground. From Europe to Asia to the United States, policymakers have largely kept interest rates unchanged in their most recent meetings, and the message behind that collective pause is worth understanding. When a central bank holds rates steady, it is not pushing on the accelerator or the brakes. Borrowing costs stay where they are. Businesses and households see no immediate change in what it costs to take out a loan. That kind of pause usually means policymakers want more time, more data, before committing to a new direction. And right now, the data is sending mixed signals. Here is the tension. Inflation across many major economies has fallen sharply from the peaks it hit after the pandemic, but in several regions, it is still running above the levels central banks consider healthy, typically around 2% per year. At the same time, economic growth has softened. Some forward-looking indicators suggest further cooling is ahead. Cut rates too soon, and you risk reigniting price pressures. Keep them high too long, and you risk tipping the economy into contraction. Neither outcome is acceptable. So policymakers are waiting. That tension is particularly sharp in Europe and parts of Asia. Export-driven economies there are already feeling the effects of weaker global demand and ongoing trade uncertainty. Central banks in those regions face an added layer of complexity. Currency movements, which can either amplify or offset the impact of domestic rate decisions. A weaker currency, for instance, can push import prices higher, adding to inflation even when a central bank is trying to bring it down. In the United States, the Federal Reserve has been in a similar holding pattern. Fed officials have been consistent. Any move toward cutting rates will depend on the data, particularly monthly readings on inflation and the labor market. Markets have been debating the timing of a first cut for months. That debate is not resolved. What comes next depends heavily on the numbers. Upcoming data releases on consumer prices, employment, and economic output across major economies will give policymakers and markets a clearer read on whether this holding pattern can continue or whether something will force a decision. The practical takeaway is this. When central banks collectively choose to hold, it is not indecision. It is a deliberate signal that uncertainty is high enough to justify waiting. For anyone tracking markets or managing financial decisions, the data calendar matters as much right now as any policy announcement. Watch the inflation and jobs numbers. Those releases, not the meetings themselves, are where the next chapter of this story begins. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.